Japanese bond yields are surging to all time records, and many seem worried about a full blown implosion. But are those fears overblown? Today, we'll look at Japanese monetary policy, including yield curve control, the shape of the Japanese yield curve, inflation and growth, the Japanese currency, their current account, and interest rate differentials to try to get the full picture. So, here in red, we have the Japanese 40-year JGB bond yield. And we can see that going back to the mid 2000s, which is all the data we have, um, they are well past the all time highs. Currently, the 40-year JGB is trading at 3.57%. And we can see that, it has moved sharply higher since April. Now, it's important, some people are looking at this and going, oh, see, the Japanese economy is going to implode, or the American economy is going to implode, or even the global economy is going to implode. Yes, the modern day financial system is very interconnected, but it's not necessarily as bad as it looks. Now, there are certainly drawdowns and negatives, and there will certainly be pain from this if it continues. And we'll get into that, but it's not inherently the end of the world. And now remember, bond yields are inverse to the value of the bond. So if you're looking for the value of the JGB, the value of the 40-year bond yield, this is what it looks like going back to 2021. And you can see that it has kind of, started to really accelerate here in 2025 and really move, sharply lower. That is what the value of the bond actually looks like. But it's not inherently a bad thing. Bond yields, remember, are supposed to approximate nominal growth. If you are not familiar with the Japanese situation, basically the Japanese economy was extremely strong in the 70s and 80s, and they experienced incredible growth. I mean, there was talk that the Japanese were going to be one of the strongest economic players in the world. And we can see that growth reflected here. This is the Nikkei. This is their version of the S&P 500, their stock index. And we can see that growth, right? In the 80s, it just went parabolic. Now, part of this was due to financiers from the West moving into Japan, not just Japan, but moving into Japan and other countries to financialize them. And, part of what started to get created was this kind of everything bubble. We here in the US have our own kind of version of that, since 2020 or so. But their bubble was really bad. And we can see that reflected here in their stock market, which experienced just incredible growth. Now, the Japanese economy was very strong, but it was not 200% in 4 years, right? There was a huge amount of excess. And basically, this was caused by many things, but inevitably, this bubble popped. And to give an illustration of how insane their bubble was, they have an acre to plot of land as kind of their palace garden for the national government office. That little plot of land, that 1 or 2 acres, was at the peak of the bubble worth more than the entire California real estate market. It was also worth more than the entire country of Canada's real estate combined. Canada's a big country. So hopefully that gives a sense of the scale of how bad this bubble was. Now, they had very strong growth, real growth, for decades following World War II. But there was also this kind of huge amount of excess that got built into their economy during the 80s. And eventually that bubble popped. We can see here the Nikkei topped in December of 1989 and then proceeded to crash, just absolutely crater. Just from December of 1989 to, what is that, August of 1990. So not even a full year. The Nikkei fell 46%, almost 47% in just a few months. I had a bit of a pop, and then it fell even lower. And from the peak to this low here, from December of 1989 to June of 1992, it fell 60%. And then you can see, stock performance was horrible. And they basically, they called it the lost decades. Um, they experienced very, very poor growth and deflation, right? This bubble, anytime there's a bubble of excess, that is inflation, right? Asset prices can inflate, consumer prices can inflate, sometimes both can inflate. Well, the opposite is also true. When you start to correct a bubble, you get deflation, you get low growth, you get low asset returns. And we can see that, if you bought in the late 80s, you were down on your investment all the way until March of 2024. um, Pretty incredible. And so when it comes to bond yields, it's not inherently a negative thing to have rising rates, right? If your economy is shrinking, right, your stocks are crashing, your real estate values are crashing, you have deflation, your economy is shrinking. Uh, a low bond yield is not an indication of a good thing. And so I think a lot of Americans have gotten used to a very particular mindset following the great financial crisis. You want healthy growth, and higher growth equals higher rates on your government bonds. Remember, the bond yield is supposed to approximate the nominal growth. And so here in white, what I want to show is the Bank of Japan interest rate. And this shows the overnight official Bank of Japan central bank interest rate. And again, if you look at this heading into the 70s and 80s, you can see that their interest rate, their official, central bank interest rate was as high as 9%. Actually, for two different occasions, once in 1980, and once in the mid 70s. And then for this period of time, heading into the 90s, it was as high as 6%. Bond yields data doesn't go that far back, but this gives you an indication that, they had higher rates because they had higher growth, right? That corresponds to the period of time where their stock market looked like this. And appeared to just be going straight up. So naturally, they had higher interest rates. Their economy was growing at a pretty healthy rate. Well, that's, we know that that bubble popped. And so what happened in the wake of that? Well, they implemented zero interest rate policy. Sometimes it's called ZIRP, ZIRP as a shorthand, but zero interest rate policy is where the Bank of Japan or the central bank of any country sets the interest rate at 0%. And a lot of times this is coincident with quantitative easing. Quantitative easing is where the central bank basically prints money, uses that money to then go buy certain assets and instruments. And by doing that, they manipulate the price and therefore the yield. Remember, the bond yield is inverse to the value of the actual thing. So what the Bank of Japan was doing is they were printing money, taking that money, that yen, and going and buying bonds. And so when that happens, the value of the bond goes up and the yield goes down, right? And we can see that as far back as this bond yield data goes, kind of the mid 2000s, bond yields fell significantly. Both the 2-year and the 10-year, all maturities, bond yields fell because the Bank of Japan was quantitative easing to target a 0% interest rate policy. To target, low rates, you have to basically buy the bonds, because bonds trade in a relatively free market. And if you want to force those bond yields lower, you have to print money to go then buy the bonds to push the value of the bond up and the yield down. And that, sure enough, that's what they did. The quantitative easing, zero interest rate policy. And what I marked here in yellow is when they started what was called yield curve control. Is finally kind of getting some discussion here in America, given some of the dynamics going on here. But yield curve control is just kind of a more aggressive form of quantitative easing. The idea here, and you can also see that their central bank interest rate went negative at the same time that they kind of implemented yield curve control. The way you do that, so a central bank is the official bank for a country, and so the Central Bank of Japan. Right. If you're a private bank in Japan, you have an account. If you're a large bank, you have an account with the Bank of Japan and you have official reserves. that you, the private bank, hold in the Bank of Japan. This overnight rate, this white line, shows the interest rate that the Bank of Japan is paying you, the private bank, to keep your, trillions of yen there in an account at the central bank. That is what this white line is basically indicating. And the way you get negative rates is you basically, charge money for banks to store their savings at the Bank of Japan. You charge them a very slight amount of money, and what that results in is a negative interest rate. And it was negative for a long period of time from 2016 all the way to 2024. It was actually negative. And we can see here in purple the 10-year bond yield was right around 0%. Their target for the 10-year was 0%. You can see there are periods of fluctuation where the bond yield goes negative or goes slightly positive. But in general, since implementing yield curve control, the 10-year had remained right around 0%, which is this dotted line I marked in yellow. The overnight interest rate was negative. The 10-year bond yield was slightly higher, right? This makes sense. And the 2-year was even below the overnight rate. That doesn't make as much sense, but we'll get into that later. So what we can see is that this policy of negative interest rates, this policy of yield curve control, where they were keeping the 10-year Treasury, or sorry, excuse me, 10-year JGB right around 0%. This all kind of started to change here in 2021. We know what happened in 2020, 2021. There was a huge amount of kind of a huge negative growth shock to the global economy. Economies all around the world kind of, responded to this sharp contraction by printing a bunch of money, trying to stimulate and liquidity injections, right, and all that. And we can see that the bond yield started to move higher before the Bank of Japan decided to start raising rates. This rate hike in March of 2024, you can see that the 10-year JGB was rising well before that interest rate hike. And the 2-year Treasury, 10-year JGB was also starting to rise before, here, about 6 months before that rate hike, the 2-year JGB was already moving higher. This goes into the concept that, the bond market really kind of is what to watch because, central bankers only kind of respond after the fact. The bond market sees it coming. And we see that here with both the 10-year JGB and the 2-year JGB. We can see that yields start to move higher in 2022, 2023, long before the Bank of Japan started to hike. So why? Well, here are a number of lines. I'll try to clean it up. Here in white, we have inflation. And then in red, we have GDP. And I marked 0% here in another dotted yellow line. And again, just to kind of really drive the point home about their strong growth post World War II, we can see that their inflation rate was significant. It was above basically 4% for decades. And this corresponded to GDP data doesn't go that far back, but you can see this red line here in the 80s was up at like 4, 5, 6%, even 7% here, 8%. Their economy was very strong, right? We looked at the Nikkei, we saw that kind of incredible performance. There was a lot of kind of real growth in there, but then there was a lot of kind of excess, right? But and then we can also see the flip side of that, which is the kind of lost decades, where following the popping of that bubble in 1990, you can see that GDP and inflation were both very low and stagnant, right? And when this white line is below the yellow line, that indicates deflation. That indicates that the economy is shrinking. Prices are actually coming down. And so this is a really important concept. They were trying to stimulate growth. By keeping interest rates low, you disincentivize savings. And if you're a bank, you don't want to hold your yen at the central bank where they're charging you money. No, you want to take those yen and go issue loans where you can charge interest. And so the idea behind low rates is to disincentivize savings and encourage lending and encourage spending. But if the price of things is going down, well, you get into this kind of self-fulfilling situation where if consumers believe, well, yeah, I want a new TV, but we're in deflation, the economy is shrinking, and that TV might be cheaper if I wait 3 months, right? You can get into this kind of cycle where, therefore, consumers aren't spending because they think, oh, well, prices will come down. If I just hold out a couple more months, prices will come down. So they're not spending and they're saving more and more and more, right? And as they reduce their spending, right, the economy shrinks. Japanese economy, a large percentage of manufacturing and industrial, but they also have a large services component, and right, that spending goes down. As consumers stop spending as much, that decreases economic activity, GDP falls, right? You get into this deflationary kind of uh, self-fulfilling prophecy where it can be very hard to get out of. And that's what the lost decades really kind of embody. Unemployment very high, growth was very low, even negative. And here I'll throw on real GDP in green to really illustrate this. This is the actual GDP. And over here, it's denominated in yen. And we can see, as of the last print, it's 561 trillion yen. This is inflation adjusted, this green line. And what we can see is that, they have had relatively stagnant real GDP growth compared to what we saw in the 80s, right? In the 80s, real GDP looked like it was going parabolic. And I mean, it's hard to even estimate, the potential GDP that Japan missed out on, from 1990 onward. But just imagine that this green line through the 80s, keeps following at the trend. And the delta between that and where it actually is huge, enormous. And so really that's kind of the measure here is, how far below your potential are you growing? Not just, you can see real GDP is moving higher, but really what matters is, what is the potential for your economy? And then compared to that potential, how much real growth are you getting? This is actually the same story in America. And I can do a video on that if people are interested. There is a huge notable divergence also in America with real GDP, personal income, a lot of things like that. I could do a video on that, but the concept here is that from 1990 onwards, real GDP was very stagnant compared to what they had gotten used to, compared to what their potential was, and you can see these periods of very sharp. Following the great financial crisis, inflation went as low as -3. They had 3% year over year deflation in the height of the GFC. Their GDP at the height of the GFC, their economy overall was shrinking at 9% year over year. And then we know what happened in 2020. But in general, hopefully you can see that, both GDP and inflation were very low and very stagnant for decades. And so this is why the Bank of Japan was, implementing these kind of crazy policies of yield curve control, zero interest rate policy, negative interest rate policy. This is why, right? It was to try to stimulate out of this kind of deflationary malaise that the Japanese economy was experiencing. Well, what do we see since 2021? Here in white, again, is inflation. We can see that inflation, rose just like it did basically all over the world to about 4.5%. Started to fall in 2022, 2023, just like it did here in America, right? It topped out, but it started to kind of reaccelerate here. And GDP as well. Nowhere in the world is doing well right now, and that's been the case for I don't know 2 years, 2.5 years. No economy is really doing that great. But the Japanese economy was actually looking like they were doing fairly well. They had kind of maybe come out of this huge decades long, low growth malaise. And it looks like it's been looking like for 6 months, 9 months, like their economy might actually start to kind of emerge as one of the strongest economies in the world. And here in purple is wage growth, and we can see that it follows. I'll take GDP off, and you can see that this follows inflation, right? Inflation is in real GDP off as well. Hopefully, clean things up. And you can see that wages have been growing, right? The wages were shrinking in 2020, but ever since November, December 2020, wages have been moving higher. And remember, this is a year over year change. So this most recent print of 2.1, wages are growing at 2.1% per year. And we can see this wage growth line follows very closely with overall inflation. And maybe it's a little bit easier to see the kind of lost decades here, where both inflation and wage growth. I mean, look at all this time that wages were shrinking, right? Imagine you at your job every year, your wages are shrinking by 1%, 1.5%, 2%, 2.5%, 3%. And you can see that, this sort of malaise was pretty prolonged and pretty hard to break the back of. Well, what did we see? We saw inflation break out higher, right? There was this brief 2014 where inflation reached 3.5% and wages kind of were growing. But hopefully you can see that this recent, the past couple of years, the wage growth and inflation is starting to look like it's breaking out of the kind of range that it had been in. It is certainly not in deflation anymore. It's certainly not contracting anymore. And in fact, moving higher. So bond yields are not inherently a bad thing when they go up. If wages are growing, the economy is growing, higher bond yields just make sense and actually indicate a good thing. Well, how does it get complicated with Japan? Japan has an extremely high debt to GDP. Their debt to GDP here in white, 236%. And in red, I threw the Bank of Japan balance sheet. Remember, we talked about how do they do yield curve control? How do you do quantitative easing? The central bank prints money, creates money out of thin air, uses that money to buy assets, buy bonds, or other instruments, but generally bonds. And by doing that, you bring the value of the bond up and the yield down, right? And Bank of Japan was very aggressive with their yield curve control, negative interest rate policy, zero interest rate policy, QE. They were kind of the most aggressive example of all those policies, and we can see the effect that it had on their balance sheet. And here in red, I denominated their balance sheet in dollars. Um, to just for kind of context, the balance sheet of the U.S. central bank, the Fed, is about $6-7 trillion. And we can see that despite Japan being significantly smaller as an economy, their balance sheet is very large, right? Almost 5 trillion US dollars worth, their balance sheet. And we can also see their debt to GDP has been moving higher, during their kind of quantitative easing, zero interest rate policy, yield curve control, QE, all those policies, where the Bank of Japan was printing money. We can see it really, really kind of took off in when yield curve control was implemented in 2015. Their balance sheet like doubled in a matter of a few years. And their debt to GDP, also has been rising. So this is what complicates rising bond yields. Yes, they are getting more growth. They are getting wage growth. Their economy is starting to grow, right? They have inflation finally. They've been dying for inflation. But there's an issue when your debt to GDP is 230%. And so it's a little different than the US, right? People talk about, oh, well, if Japan, their debt to GDP is 236%, and in America, it's only 121%. See, everything's fine. Well, it's a lot different. People that make that analogy are missing a number of key points, very, very key points. One of which is the US runs a twin deficit and Japan does not. Um, so remember, when it comes to this twin deficit, what is that? That's the trade deficit, your balance of trade, your imports versus your exports, and then your fiscal deficit, which is government spending versus government revenue. And for here, we're going to focus on the balance of trade. This is the value of imports versus the value of exports. And here in white is the monthly current account balance. And we can see that Japan has run a current account surplus for as long as the data goes back. What is a current account? Current account, the main component of the current account, there are a number of components, but the main one that makes up the vast majority of the current account is the balance of trade, is your imports versus your exports. And we can see that Japan has run a massive current account surplus. This is denominated in yen, I believe. Yeah, this is denominated in yen, but I will show it in dollars since most people watching this will be American. They run currently, as of the most recent data, $24 billion per month current account surplus. What this means, functionally speaking, is that money is flowing into Japan, right? They are not consume they are making a bunch of money, right? They're selling Toyotas and Hondas. They're making all this money. We are sending them all this money, but then they're not spending it, right? That is what a current account surplus indicates, is that they are not importing with those. They are not taking those dollars and then importing a similar amount, right? If they sell $100 billion worth of Honda cars, they are not taking that 100 billion that they just got and using it to import $100 worth of stuff. That's how you get a current account surplus, or a trade surplus. And we can see that they have run very large current account surplus. Generally speaking, over 10-15 billion dollars per month. Right, America's balance of trade is about negative $140 billion per month, but we are also a much larger economy. As a share to their GDP, they have run a very, very strong current account surplus. Not quite as strong as China, but very, very strong. And theoretically, right, the way that this used to work under gold standard, kind of pre Bretton Woods, pre fiat, is that as your country makes a lot of value. They produce a lot of value for the world. So they get a lot of money, right? Your country gets a lot of money from the rest of the world as they buy your stuff. Well, we just kind of established you have two choices. You can save money, or you can take that money and convert it into your local currency to spend on whatever domestic things. You can use that money to import an equal amount of stuff, right, from the rest of the world, or you can save it. And generally speaking, as wealth flows into your country, theoretically, the idea is you don't just kind of hoard it, right? You're getting if you're Japan, you're getting dollars from America for Hondas and Toyotas. You're taking those dollars, selling the dollar to buy yen. So that puts downward pressure on the US dollar, upward pressure on the yen, right? And then you use those yen for domestic things in your domestic economy. That is kind of very theoretically, conceptually speaking, how it is supposed to work. So if you run a current account surplus, your currency should be very strong, because another way to think about it is kind of you are a heat sink, right? For every dollar of current account surplus, you are kind of putting downward pressure on all the other countries' currency and upward pressure on your own. Well, we know, as I've gone over many times, a number of countries don't like this. They don't want a strong currency because when you have a strong currency, the other side of the coin, yes, it makes imports very cheap, but it makes your exports less and less cheap. This is the issue with the dollar and America, is our dollar is so grossly overvalued. Exports just don't make sense. So if you can, and you have an export heavy economy, or China, number of Asian countries, right? They have these current account surpluses. They don't want a strong currency. They want a weak currency. They actually want a weak currency. And not only do they want it, but they do things to enable a weak currency. This is the kind of currency manipulation that you hear the current administration talking about. Well, how does that work? Here in red is the foreign exchange reserves. And what this shows is savings, right? We established there's kind of two choices. You can take all those dollars you're getting from America, sell the dollars, buy yen, or you can just kind of hoard the dollars, right? Just store them away. And that's what foreign exchange reserves indicate. This is what kind of the national savings account looks like. And we can see that, going back to the 80s, their foreign exchange reserves have moved notably higher. And the other way to think about this, for every dollar in this foreign exchange reserves line, that is removal of selling pressure on the dollar. So It's currently 1.27 trillion in US dollar terms. The other way to think about that is 1.2 trillion dollars of selling pressure that theoretically should have happened in the dollar but didn't, right? 1.2 trillion dollars of selling pressure that should have happened in the dollar and 1.2 trillion dollars of buying pressure that should have happened in the yen. And in fact, that's not what happened because instead of converting those dollars, now of course this is not just dollars, but just trying to illustrate the concept. Instead of taking those dollars and selling them to buy yen, they stored them in this red line. This is their foreign exchange reserves. And in green here is their is the dollar yen cross. And so the dollar is the numerator, and what that means is when this green line is moving higher, the dollar is strengthening. And when the green line is moving lower, the dollar is weakening. And so this is a phenomenon not just with Japan, but other countries as well. And so when you run this huge current account surplus, you have all these your country is getting wealthy, right? You're getting all this money and you don't know what to do with it. Well, you can buy bonds here in red. The scale's all messed up, but some months it was positive, some months were negative. I don't know why my line disappeared. You can also buy stocks, foreign stock investment, and I'll move the line to about zero. So you can see that some periods of time they were selling foreign stocks that they held. Some months they were buying stocks that they held, um, or you can store them as foreign exchange reserves. And that's what we see in that red line that we were showing is the foreign exchange reserves. We know Japan has been a huge buyer of US Treasury debt. Um, they have over $1 trillion of US Treasury debt. And again, foreign exchange reserves, most of the time they're not just right, they're receiving dollars. They're not just storing dollars, they're buying treasuries, which are basically dollars, because they're dollars that get you interest. And they own, over $1 trillion of US bonds. So where your mind might be headed here uh, is the correlation between the dollar yen and the 10-year yield. Um, I've talked this a long time, but this correlation is extremely tight, right? And the reason is just kind of structural in nature. And what I want to point out, zoom in a little bit, um, is that we covered in maybe a month ago in early April that interest rate differentials started to diverge from the dollar yen. Oh, this is just the 10-year. This is just the 10-year. Here we go. So here in red is the interest rate differential for the 10-year, right? So you take the 10-year treasury interest rate, and then you subtract the Japanese 10-year interest rate. And then in purple is the same exact concept, but for the 30-year bond. And we highlighted in early April that interest rate differential started to diverge, right? Generally speaking, just think about it intuitively. If you're global money and you can get a higher rate in the US, right? If this line is going up, indicating a positive spread where you're getting more money for holding the US bond, more interest, generally speaking, that, global will flow into that bond, right? Those bonds. And so as this line moves higher, theoretically, the US dollar should strengthen. And generally speaking, that is what this is called the interest rate differential. Generally speaking, that is what has played out. As the interest rate differential for both the 10 and the 30-year has moved lower, the dollar has weakened, as we can see here in white. Well, something kind of changed in early April. With Liberation Day and all that. Go back to my early April videos, and I covered it more extensively. But interest rate differentials and the currency started to diverge, where we can see here that the dollar has actually kind of started to strengthen, even though the interest rate is lower. Right on the 30-year, the interest rate that you get in America is actually lower than the one that you get in Japan. And you can see on the 10-year that it's about flat going back to early April. The interest rate differential is basically unchanged. Well, there's been this kind of bit of a divergence where the strengthen, despite the relative kind of appeal of U.S. bonds going down. And so I think that that's a really important concept, really important thing to watch. What we have seen in Japan is now they basically have two choices, right? The value of the bonds is plummeting, as we established, right? Inverse to yield. The value of the bond is plummeting. Who holds the bonds? Well, the central bank holds the bonds, and then insurance, pension, right, financial firms, banks hold the bonds. This is exactly what caused the regional banks here in America to blow up in 2023. They had been told just buy all the bonds, right? At 40, 50 basis points, 0.4% 10-year treasury. Yeah, buy it. Well, then what happened? Rates, skyrocketed higher. The value of all those bonds that the banks had bought in at very low interest rates plummeted because now, who wants your 10-year piece of paper that only gives you, 0.4% when I can go over today and buy one that gets me 4.5%, right? And the longer the maturity, the more pronounced this is. So, with a 40-year bond interest rate going up 1% is disproportionately more than a 2-year bond going up 1% in yield. The longer the maturity, the more pronounced the effect is. And this is what happened in America, causing the regional banks to blow up, is the value of all the collateral that they had been holding, basically in a matter of a couple months, plummeted in value. Well, Japan kind of faces two different scenarios. They can, currently it does not appear that there's any issues with the currency. If anything, in recent days, the yen has actually strengthened, right? You can see that here since the 12th. So about the past 8 days, the yen has actually been strengthening, which is not what you would envision happening in a collapse, in this cataclysmic sort of collapse that people are talking about. You would not see the yen strengthen. Well, why is the yen strengthening? The yen is strengthening because all those savings that we had just talked about, right, with their current account, their foreign exchange reserves, right, all the money that Japan had made over the past, I don't know, 5, 6, 7 decades, all the savings of Japan, that a lot of which had been put into US assets. Well, now if their bond yields are higher, right, that's more enticing. If you're a Japanese business private person, a higher interest rate is more enticing. Um, this is why it's really important to look at the value of the currency relative to the interest rate differentials. And so, yeah, so I think the fact that the yen has strengthened over the past called a week does to me not indicate concerns. If anything, what it indicates is that all that savings that had been in U.S. dollar assets, right? Think if you're a Japanese business person, you have a bunch of treasuries, a bunch of US stocks. Well, say you see your domestic interest rates moving higher. You think, well, yeah, I don't really want to be in US stuff anymore. I want to be in Japanese stuff. The interest rate's finally high enough to kind of incentivize me to do that. I'm going to sell my US stocks. I'm going to sell my US treasuries. uh, you as the Japanese business person, once you sell those assets, you now have dollars. Now you want to buy a JGB. You want to buy a Japanese government bond, and you can't do that with dollars, right? You need yen. So what do? You sell those dollars that you had just got for your U.S. assets. You sell the dollars and buy yen. And that is basically what we're seeing to some degree is the yen is strengthening. Well, why would the yen strengthen? This is indicating that foreign capital is flowing into the yen, right? If you want to buy a JGB at 3.4%, you need to first buy yen, right? So watch the currency, and what we've seen over the past week is the currency's actually strengthened. What this indicates is that foreign capital is buying yen because if you want to buy JGBs, you need to buy yen first. And so if the value of the currency starts to collapse, right? If the dollar yen cross starts to move sharply higher, indicating yen weakness, that's a different story. But what we've seen over the past week, as yields have risen dramatically in JGBs, is the yen has actually strengthened, and this is a healthy sign, right? This indicates those higher yields are enticing global capital to flow in to buy those JGBs. Now, what you don't want to see is what we saw here in America in early April, which is bond yields up and your currency down. That is what we saw here in America in that kind of week-long period where we were basically experiencing a balance of payments crisis. That's what you don't wanna see. But, you know, uh, over the past week or so, that's not what we're seeing in Japan. Their currency is strengthening. And so they basically have 2 choices here. We established inflation and kind of nominal growth is higher. We established that a lot of pension funds, insurance funds, financial institutions own all those bonds, right? All the bonds that were being issued in the zero and negative interest rate policy just plummet in value. The higher these yields go, I will inverse this to hopefully give a sense of the value of the bond, right? This is the value of the collateral plummeting, and remember, it's more pronounced the longer out you go. So here I'll throw the 40-year on. You can really see how pronounced this is. This is the value of collateral that pension funds, banks, right, financial institutions, this is the value of their collateral, and it is plummeting in value, especially at the longer maturities. So they kind of have two choices. They can let a country always has a release valve, which is their currency. If you don't care about the value, the exchange rate of your currency, the value of your currency relative to other fiat currencies, debt is not a problem. Just period, end of story. Now, your people might be very unhappy with you if there's 20% inflation every year, but theoretically, there really is, the currency allows for governments to do kind of whatever they want. There's always a release valve, and that release valve is the currency. And so this is what I think, to summarize, this is what to watch. Um, Either they, in my opinion, either they let the kind of either they let rates continue to move higher, which is they have said, that they are kind of stepping away from quantitative easing, yield curve control, zero interest rate policy. They've made that clear for a while now. Uh, Either they continue to do that and continue to let kind of inflation accelerate, right? And that's not inherently a bad thing, right? Wages might actually be growing faster than inflation, so your people are actually benefiting. But it's a hotter economy, right? More inflation. Uh, and you stick with your kind of, we're stepping away from yield curve control. And as yields move higher and higher and higher, the value of the collateral for all those financial institutions, pension funds, insurance funds, continues to plummet in value, and maybe a couple of them go bankrupt, go bust. But that's your choice. Or you go, okay, we can't just step away from yield curve control and QE. We actually got to go back to it, right? We had tried to kind of step away from that whole approach, but we can't let rates continue to move higher. We have to basically start printing money again to buy the bond to get the rates to come down. Well, if that happens, the value of the currency will be the release valve. And so again, so I think that the interest rate differential is really important to watch. We saw in early April, despite US interest rates being higher, right? The relative yield for US assets was actually higher than other, or around the rest of the world. Despite that, money was actually flowing out of the dollar, not into the dollar, which is what you would expect during this week in April here. Interest rate differentials moving higher, but money flowing out of the dollar. And so this is what I think is key. Yes, Japanese bond yields are rising. Yes, they are rising sharply, but so are American bond yields, right? The 30-year was brushing up against 5% earlier, just before this video. And so again, remember, everything is interconnected. And so you have to evaluate it not just on its face value. You have to look at what is growth. We just talked about this in the prior video. What is growth? What is inflation, right? You have to take the full picture when you're looking at bonds, especially. You have to really evaluate currencies, growth, right? Inflation, you have to take the full picture into account to try to get an indication of, is this cataclysmic or is this just, to be expected? And so I think interest rate differentials and the value of the currency indicate that so far, money is actually flowing into the yen, indicating that there is some demand, right? And we established, hopefully, that the current account for Japan is enormous, right? They have been running this very strong current account surplus for decades. They have accumulated both their government as well as uh, their institutions, right? Their businesses, as well as their individuals, have accumulated huge amounts of savings. And there's a time for that savings to return home. And now I'm not saying that this is happening in mass. I am just kind of illustrating that the yen has strengthened, indicating that the all that money that the Japanese had saved from running current account surpluses, that can go back home. If yields are high and all those Japanese business people, institutions, the government wants to basically bring all that money home, right? Sell all the foreign assets, U.S. Treasuries, U.S. stocks, right? That they've accumulated, sell all that. They get dollars, sell the dollars to buy yen. You would see yen strength. And sure enough, that is what we have seen since January of 2025. The yen has been strengthening, right? Remember, dollar is the numerator here. So as this is falling, the yen is strengthening, the dollar is falling. Um, and as rates have kind of skyrocketed higher, the dollar yen has actually showed yen strength. So now, if this starts to reverse and the yen starts to dramatically weaken, that could be an indication. Okay, things are kind of getting bad. But until that happens, it doesn't appear like this is some sort of cataclysmic end of the world sort of scenario that some are trying to paint it. So hopefully that was helpful. There's a lot to touch on. I know we got into a lot. It wasn't everything, but hopefully gives you some try to, hopefully objective kind of pragmatic look at things. Uh, if you want me to do that video on the silent depression or the below trend um, growth here in America, let me know in the comments. I'd be happy to do that. See you guys.